get this up. Let's get this set up. Okay, as they say on the amazing Clubhouse, just gonna ping a couple of people into the room just to get some reminders, make sure we have a good day of Q&A today. So I'm just in the process of doing that now. Amazing. Okay. So I am back. I'm Kazy from Property by Kazy, and today we have another episode of somebody else with Sherena. So I've just pinged her in. Hopefully she'll be here very soon. For those that don't know, or it's your first time here, it is an opportunity to ask an industry expert something within the property space. Today, we're going to be focusing on all things finance. Yeah. How you doing? You okay?
I'm good, thank you. How are you?
Good. Just making sure you could hear me. I wasn't sure. Do you know what?
Yeah.
And I had a load of phone calls come through and I was being a rubbish host. So I'm going to introduce you very shortly, but I'm just going to introduce what we're going to do today. So today, again, is an episode of Ask Somebody Else. It's the premise where basically you get to ask somebody some questions within the property space. Today is a finance episode, and we have Sherena on. She's got over 10 years of experience. So hopefully she's going to really help us with all those questions that we want to know. I've got some questions myself. I'm going to put her on the spot and really test her knowledge, see where she's at. But hopefully this is really going to give back and help loads of people that potentially are either looking to buy their first property, buy a to let, buy an investment property. So can we get a little introduction?
Yeah, sure. So I'm Sherena. I work for a specialist lender. So I help investors, developers get finance for bridging, development finance, buy-to-lets, and also first-time buyers who are looking to invest. So I do everything kind of in that spectrum. As it's a specialist lender, it's not your high street kind of bank. So it's more quirky finance, quirky properties, and a little bit more less black and white kind of tick box exercise. And then also just on a personal side, I also have a portfolio of properties in the London and South East. I've had those for about 10 years now, and they're single buy-to-lets, and that's just kind of been my strategy.
Nice. So I think a few people have sent me questions that potentially weren't able to be here today, but are going to catch up. This is going to be posted on YouTube afterwards. So one of the first questions was your opinion on the 95% mortgages.
Sure. So just to kind of clarify, so I do non-regulated mortgages. So I do any things you don't live in it. It's literally investment. So I can give my thoughts on it, but in terms of, I can't give any advice.
Of course.
95% mortgages, I think it's good because it will help people kind of be able to, get onto that ladder, especially if they've got good, income earnings in terms of salary, but they just don't have the ability to build up that deposit. So when I say that, I mean, the people that might have, very large salaries, live in central London, pay a lot of money on rent, so they can never save up for their deposit. So they want to buy a property, but they just don't have the ability because their deposits are low. So I think it's really good for that kind of aspect. But my biggest fear is if the property market shifts, you might get negative equity quite easily, especially when you're putting down 5%. So to me, I always, especially when I'm buying, I'm always trying to put 10 to 15% because just to give myself that buffer that if another 2008 crash happens, I'm not going to be panicking that I've got a property got, worth less than what.
Yeah, because even if it shifts a little bit, I'm right in saying, let's say they're doing 5% mortgages now and you're tied in for, 3 years, for example. If at the end of those 3 years, if the property's only dropped by 1%, if you've only got 4% equity, there might be no 4. So you're kind of, I think it's called like mortgage prisoners or something like that. People who can't sell, can't move, and they're sort of just stuck.
There won't be that many people that will probably refinance you. So you'll have to just stay, and they could probably put you on really silly rates.
Because that's the other thing I've seen about that, particularly as people shift, even in this current climate with, the pandemic, some people that are potentially furloughed earning less, and actually they've ended up on some ridiculous rate mortgages because they can't refinance
Definitely.
And their current, with their current deal, because that was based on their existing circumstances. So yeah, guys, again, thank you everyone for being here, taking your time off on your Sunday. I was almost late today myself. I've actually been on time like 6 weeks in a row. I was almost late, but just slid in at the last minute. So yeah, if you do have any questions, make sure you get them in. I've seen we've got a couple that have come through already. But yeah, you can either ask them through the question box or just in the chat itself. So one thing that comes up over and over again is auction finance. Everybody, I think a lot of people that want to get into property are like, really, we're not sucked in, but it's attractive when we see the guide prices of some of these properties at auctions, and your mind starts to spin and you think, oh, what if, I get it for that price and I can add value. But obviously you can't use conventional finance for an auction purchase. So can you speak to us about what the best type of finance would be to use?
Sure. So with auction, you have 28 days usually to complete. So if you can buy it cash, then amazing. If you can't, then you're going to need something like a bridger to bridge it. And to do bridging finance, you need to go to a specialist lender who can provide that finance. In terms of bridging, a lot of people say that bridging is expensive, but we need to demystify that a little bit, because that is affordable. And the reason you use a bridge, and you are going to pay a premium because you're getting a premium service, you want quick finance. You want that finance within 28 days. So bridging is probably the best thing to use for auction. Make sure that your lender can do it within that time frame, because there is bridgers that will say they can do it in 28 days and may not be able to. But bridging definitely is the product to use if you're going to do an auction purchase.
So do you work with multiple lenders or just a specific lender?
So I'm a lender. So
okay.
Come to me for the fine. I'm the bank. That is.
You are the bank. Wow, impressive. That's what you should have in your bio. I'm the bank.
But yeah, so your broker would kind of find the lender that works well in terms of, depending on the property, depending on your timescales, they'll be able to kind of tell you which lender can basically get your finance and completion within that time frame.
Okay, nice. I think one thing you touched on that was good there was obviously about the myths about bridging is expensive. I mean, bridging is more expensive than your residential mortgage and more expensive than your buy-to-let most of the time. But I think bridging is expensive a lot of the time because the fees are very in your face. They're telling you this is what you have to pay. If you don't pay it, you're asking. Whereas with buy-to-let, a lot of the time you have your fees are hidden maybe in a high survey cost, a mortgage redemption penalty, which for some of the products now can be up to sort of 5% in the first year, which can be a lot. So I think it is right to kind of make sure you caveat with what fees actually are depending on how long you were looking at buying somewhere for. But that's very interesting. And then in terms of
if the property is in a mortgageable position and you don't need to do any works on it, there is lenders that can also just put you straight onto debt, and it can be done within 28 days. It's not always I'm buying at auction, I need to get bridge finance, because you might actually just be able to go straight onto a buy-to-let. And the lender I work for, you can do bridging and buy-to-let within the same amount of time, so we can complete. So it's all down to, is there works needs to be done? Can it be mortgageable? Do I need to go down bridge finance? If not, can I just put it straight on a buy-to-let?
Okay, no, that's good. Somebody has just asked, so they said, is it better to get a buy-to-let mortgage that allows an early refinance, and what would be the implication of that?
So I don't know what context that's in.
So I guess there are so obviously for example, some mortgages don't have an early redemption penalty. So I guess it's flexible versus fixed rate almost. And the difference between the two of being on a flexible product versus a fixed.
Yeah, so I suppose the biggest one is your early redemption cost. So if you're on a flexible, you can leave, you can probably get equity out without having any penalties. Or if you're in a 3, 5 or 10 year you have to wait for that fix to end, or you have to pay a redemption, which could be 3%, 5%, depending on the lender. So it just stuck there for a longer period of time. Also, if you're going to sell, if they don't let you port the mortgage over to another property, you might also be stuck with paying a penalty.
I've never done that. I've never even thought.
Be honest,
could I do that?
buy to lets. You can port residentials, but I don't know if you can. So disclaimer.
Yeah. Yeah, no, it's just funny because I've actually heard about porting. It's been mentioned to me a lot, but I guess, yeah, I don't work in a residential space that often, but I've never thought to myself, oh, I need to port a mortgage or, but definitely I think that would be something I might look into in the future.
Yeah.
Let's have a look. There were a couple of questions that come through.
Quite a lot of questions. I'm looking at them, but I'm like,
There's a lot. Is it better? Can I save this live? I will definitely save the live, and I think I'll upload it to YouTube. So if you're not following the YouTube, quick plug, go and follow my YouTube, subscribe, and you can see it there. So okay, I guess this is kind of I'm not going to ask the exact way they asked the question. Is how can you ensure you can obtain bridging finance, and how can you be sure that you're going to get it within a 28-day period?
Sure. So if we just take a step back with, let's talk about auction properties, because it might be kind of a live example. When a client's going to auction, there might be 3 or 4 properties that they might be interested in. So when they come to myself, I will put those 3 or 4 scenarios to see if it works. And then if it does, I'll be like, okay, up to 700, 500,000 you can bid for, and we're happy to give you that finance, subject to credit scoring, because it's all just done very high level. Now, once that hammer drops and they get that property, they then come back to me, and we will, as quickly as possible, instruct solicitors and surveyors to kind of get that property valued and the legal pack start to be worked on. Now, if the key is to have a very good solicitor as a borrower that knows how to look at auction packs, look at legal packs, and can work quickly. Key thing is, I have a lot of solicitors on the borrower side that just don't have capacity. So they'll say, I've got a solicitor, but that solicitor just doesn't have the ability to complete 28 days. If your solicitor can complete within 2 weeks, brilliant, because all the lender's going to do is try and complete that loan as quickly as possible. So if the lender said, we've got capacity, we can do it within 2 weeks, 3 weeks, it's all as how quickly can both the solicitors get to that completion aspect, and how quickly can that valuation come back. So key things I would say is make sure the lender's got coverage for surveyor to be able to go out and get that report quickly. Also that they have the capacity to get the deal done. And then also your solicitor has the capacity to get the deal done. And if all those work, then there shouldn't be an issue with completing within 28 days.
Yeah, and I think that's really key. A few things you said. I was watching, I'd like to shout them out, but I can't remember whose place I was watching, but they were just talking about obviously timeframes. And a lot of the time, there is a lot of, or from my side, there's a lot of, obviously you want to ask people like the solicitor and the surveyors, and are you available? But also, if you know you've got a 28-day deadline, don't just say, oh yeah, I've got a 28-day deadline, but they told me they're going to do it, so I'll just leave it in your hands. You have to kind of have manageable deadlines. Okay, I would expect the survey to be done within this time frame. I would have expected to have inquiries sent out by X deadline. If you're not meeting those mini deadlines, chances are you're going to potentially fall foul of meeting your 28-day deadline. I mean, the good thing about the current climate is quite a few auctions, particularly if you buy like pre-auction, are offering quite good completion terms. So you can get those potentially extended from 6 to 8 weeks. I've seen on my side of things.
Yeah, we've seen quite a lot of sellers that have extended a week, 2 weeks past 28 days. They're being very flexible.
Yeah, which is good. There was something else you said that I wanted to touch on. Credit scoring for bridging, because some people get bridging on the basis that they're not eligible for more conventional finance. Will a bridger lend to anybody?
So again, it's not like your high street bank, so they don't care much about your credit score. All they want to know is you don't have to have a good credit score, you don't have to have credit behind you, but they don't want you to be someone that's got £20,000 worth of county court judgments outstanding.
Yeah,
they want you to at least have clean credit. But then even if you have got bad credit, it just means your bridging pricing will just be more expensive. So depending on how good your credit will determine your rate, basically. So we will look at adverse. So you could have missed mortgage payments, you could have had a county court judgment, you could have basically not paid your credit card for 6 months. We'll look at it, but you might not like the price that you're going to get.
I feel like dealing with bridges potentially is almost like being able to talk to the underwriter directly, in that you could kind of justify scenarios. If they say, look, you've got a missed mortgage payment, and you say, yeah, but that was the time that I don't know, I'd switch banks and X, Y, and Z, and you present them evidence, like you're more likely to actually have a conversation. It's less of a computer said no scenario.
100%. Get that
And
copy. I've had it a few times where I'm like, just show me where the bank statement was. I showed you had that £2,000 for that
that
payment.
had it at the point, and
Yeah,
then yeah, we can take a judgment on it. And also, if you're bridging, it's like you're spending money to make money. So you should have taken those, those what those costs are into account, and you're probably doing it on the basis that you have the potential to make a lot more on those fees. Ooh, where's my phone not charging? Sorry, I thought it just turn off. Okay, we're good. Yeah, throughout the process.
but also
Uh,
what we'll do, and that's on a bridging finance or development finance or refurb bridge, they will kind of stack that deal for you as well. So if the finance cost that I'm charging you costs more than what you're going to make as a profit, you might not get the finance just because it doesn't make sense. You've got no
yeah,
profit. So we do.
again, I think that leads right into a question. So, what do you ask to see? Like, if I approach you and I say, like, maybe this is my first time at auction, I want to buy X property. I might want to refurb it. I might have planning. Do you want to see potential? Like, what do you want to see from me as a borrower?
So if it's just you're buying the property and you don't need planning and you're just going to do some work, do a bit of a refurb, we'll just ask for the schedule of works, and then basically what you think you can sell it for, what's your comparables and what your flip cost price would be. And then we'll just do a bit of a calculation saying, look, after you've paid for the property, paid stamp duty, paid solicitor valuation fees, cost of works, plus the finance costs, broker fees, whatever else there is, are you making, usually want to see 15% profit. So if you're not 15% and you're going to sell it, we're probably going to ask the question to why do you think this is a good investment? Now, when we say 15%, if that, say it was, you were making 100,000, but 8% profit, then that makes sense because it's still a big monetary value that you're getting on the flip.
Yeah.
But if it was making 8% and you were only making 7 grand, we'd probably say, what
Yeah,
if things overrun or anything happens, you're
because
probably
your risk and reward doesn't marry up because you're a bit overexposed in that scenario. And I guess that's the way for people who asked about the finance cost. That's just the way that the lender would look at it. That if you're considerably higher risk because you've had late or non-payments, they're just going to charge you more money because it's like, if I want to take a chance on you, then you need to give me better odds.
exactly that. Not saying we're all doing this, but you're trying to get as much money out of that person, especially if they're more riskier, because we want to know that you're going to continue or at least finish off that project and give us our money back, basically. Nobody wants to stay on a 1% a month bridge for very long. So you hope it will drive them to finish it much quicker than sit on there for 12 to 15 months.
No, exactly that. I've got the odd chaser letter from our bridger asking, can you confirm the property is now on the market? Can you confirm that your plan has been accepted? Good, you're very right. You definitely do need a good solicitor. I don't know if it's next week or the following week, but we actually have a solicitor on in a couple of weeks, the property lawyer. So yeah, definitely if you've got any solicitor related questions, make sure I'll do an update after this and let you know who's on for the next few weeks. What do you know about right to buy and releasing finance from right to buy? Because I think 3 people have asked this question now. I personally haven't gone down the right to buy route, so I don't, I know obviously there's a time frame you can't sell within.
Yeah.
Do you know much about it at all?
So again, it's a regulated product. So right to buy, I think you've got to own the property for a certain amount of time. I want to say 2 or 3 years. But in terms of, is it just to kind of get money out? Is it for refi?
Yeah, so I think you can't sell for the first 5 years if I'm right.
But refi, that's a possibility once you've bought it because it's your property. You can refi. That's not an issue. It's just if you're going to try sell or make it into an investment property, I think there's a waiting period. You've got to wait.
Yeah, I think to sell definitely, but I believe you can refinance. I'm pretty sure because you're not selling, you're just withdrawing your own money in effect. But I'm sure there will be. I'll try and find out. If I do find out any more about it, I'll have a conversation with somebody I know who's actually a specialist in the area. So I'll have a conversation with them and I'll do a little post about it for you guys because don't want to feel like I've just left someone hanging on their questions.
People that have just said own it for 5 years, but definitely refi, you can refi as long as you own it. That's not an issue.
Yeah. And again, a lot of questions are a lot of them are about regulated products, purely because obviously I think the people that follow me are quite new on their journey. And for most of us, our first investment into property is our residential home.
Mm-hmm.
So this was just about consent to let
Mm-hmm.
on a residential mortgage. Is it expensive to get consent to let?
So how consent to let works is you would let your lender know now that you're not going to live in it, and it could be for whatever reason you're moving away for a different problem to find another property nearer to your workplace, or you can't afford it and you need to rent it out. It could be any reason. And what you ask your lender for that consent to let, but that consent to let is not forever. That is them telling you, okay, we've given you that consent, but when the term ends, so say for example it's a 5-year fix, you will have to refinance onto a buy-to-let product or go elsewhere and find a buy-to-let product. So there's no cost for that consent to let because a lot of lenders will just do it. But you just have to be mindful that if you've got a 95 or a 90% mortgage and you're asking for a consent to let, there's not many buy-to-let products at that range. So you're going to have to start paying down some of that mortgage because typically you're going to find 75% buy-to-let mortgages as a max at the moment. So that's the only thing there if you're very highly leveraged on your residential.
Nice. I hear a lot about development finance. Is development finance like what is it? Is it different to a bridging loan? Is it the same? Where do the rates stack in both of them? Talk to us about development finance.
So there's two. It depends on the lender. How they define development finance. So we got development refurb finance, and what that means is we provide finance for anything that you're converting. So as long as you're not knocking it down, but you're converting, you're extending, you're going story, we can provide finance on it, and it's still done on a bridge because it's a short-term product. And typically what we do is give you the money for the purchase. So let's say 5% for the purchase plus 100% of the works on top. You can actually get all your works funded. It is in arrears, so you have to spend 30,000 of your own money first and then you get reimbursed.
Okay.
So that's one aspect. Then there's the proper development finance ground up stuff where you've got a piece of land or you've got a house, you're knocking it down and you've got planning. And again, that it's not on a bridge, it's not on a term, but it's on a development finance facility, which could be anything up to 2 years or 3-year facility, depending on how big the scheme is as well.
Okay. So for your like just conversion development finance, do you package the purchase and the works as one finance package, or is it two separate products?
So it depends. If the property can be converted or done without planning, so under P, or you have got planning, then it can go straight to the refurb product, which means you'll get that in that same product, you'll get the purchase plus the works. Now, if you haven't got the planning and you've got to get the planning, then you can put it on a bridge first. To get the planning, so we'll give you the money towards the purchase, and then once you get the planning, we flip it onto that refurb bridge, so you can then have works as well on top. So it's all dependent on what planning or not planning you have on that property.
Okay, fair enough. And for I think somebody, I can't remember who, but asked for the initial purchase, what's your maximum that's offered, like from a loan to value perspective?
So typically lenders are going 70 to 75% on bridging. When I say 70-75, that's the gross figure. So just to quickly do some bits and pieces on bridging. So with bridging, a lot of lenders will either make you service the interest, or they'll retain the interest or deduct it, however you want to call it, or they'll roll the interest. So what is, if they're giving you 75% and then the interest for 12 months is, let's say, 50,000, and the loan that they're going to give you is 200,000, they will take away that 50,000 interest, which means you'll now get a loan of 150 because you've paid your interest
And that's your net loan.
Your net
amount,
loan.
right?
50. So the gross is the 75, but by the time it's been netted, it might be 70, 72, depending on what the fees are. Sometimes you can service it. The only time they'll let you service it usually is if there's income coming from that property, which means they don't deduct the interest, you just pay it every month. But no one wants that because it's a bit messy, because whilst you're doing your build or your construction, you don't worrying about every month I've got to make sure I've got £1,000, 2,000.
Yeah, and a lot of the time it's a lot more than that if you're doing a large project. I think I've never serviced my loans, just purely for that reason. I think I could understand why somebody would if you were in a business that cash flowed really well and you were just, I don't know, you were just getting into developments maybe off the back of a business that cash flowed really well. It might make sense because you didn't have as much capital, but you knew you had the income. But I think most of us that have been doing developments for a little while have built up like a working capital pool that we know what we have. It's not going to extend massively over the next couple of months. So why not pay in advance? Alfred, how you doing, Alfred? Alfred has asked a question. Alfred's actually coming on in a couple of months because we were really busy, but Alfred's going to be on very soon to discuss his amazing HMOs in Coventry. He's asked, when you request the development element, once you get the planning, do you effectively pay double the fees rather than if you were to do it without planning? Sorry, if you were to do it with planning, basically, is it more expensive to go down buy the property, then get planning, and it's sort of almost two separate products?
So how we do it is we only charge fees on any additional monies you take out. So if it's say for example on the bridge I gave you 100,000, and on the refurb I'm giving you that 100,000 to repay the bridge, plus I'm giving 1,000 for works, you're only going to pay the fee on the 50,000 because you've already paid it.
And I guess when I was speaking to Sam Norris about this, his argument for potentially doing it that way was obviously if you were to take the money, potentially take all the money up front as basically a loan against the GDV, for example, if you bought a site with planning. So you're actually taking like loads of money to start with. You're paying your interest over the whole sum on day one. Whereas if you have like a drawdown facility on paying for the works in arrears, then you, even if whatever your interest rate is, you're paying it on a percentage of the loaned amount. So you probably pay a lot lower annualized interest if you do it that way as well. So I guess it depends how it stacks with your fees. But I'm sure for someone as established as Alfred, he's got an amazing spreadsheet and he knows exactly what he pays and wouldn't pay a penny more than he has to.
Yeah, most refurb products will have the tranche aspect, so you shouldn't pay any interest on the facility until you draw it down. People do come to me and they don't want the refurb because they've got their own cash to do it, so they just want a bridge. But the advantage and disadvantage is on our products, on a bridge we deduct that interest like I mentioned to you, so your net figure is much less, whilst on our refurb we roll the interest. So if I'm giving you 75% gross, you're actually going to get 75% gross day one because all the interest gets rolled till the end when you pay it off, so you get better day one money basically.
That makes sense. So I don't know, this might, again, if there's too many moving parts, but I've actually got a deal I was looking at. So I went to view it earlier this week and I'm in an hour in between options of how to finance it. So effectively purchase 800,000. It's probably worth 600,000.
Later, Kazy, you're gonna. Do I need a calculator?
Maybe a little notepad. You got pen and paper ready? It's not a test. But, I might fail you. So basically, purchase price is 800,000. But without planning, it's probably in its current state worth 600. But obviously, the vendor's aware that there's a significant uplift. The GDV is 1.7 million. And our works are probably circa 350,000. Okay. What do you reckon in terms of a finance structure? Best way to structure a finance deal like that? Where would you place that?
So if you don't get that planning before completion, then we go on the as if on day one. So we'll give you 75% towards your purchase.
Yeah.
and then we will use the GDV figure. So we don't want to extend past 70% of loan to GDV. So with the purchase plus the works plus the interest rolled up, as long as you don't exceed 70% loan to GDV, we can purchase money and the works money, and we will put that on what is it? What are you going to be doing? What's the actual end project?
So refurb the existing house and new build house on the land.
And sell, or to keep?
Sell the entire asset.
And do you think you can do all that in 12 months and sell, or would you need like 15 months?
So if we can get planning, we could potentially get an option to get planning to get planning beforehand. So if we get planning beforehand, yes, we can do it in 12 months. If we can't get planning beforehand, then no, we probably need 18 months because we have to take into account the planning. It's very slow at the moment. And
what if, is it a purchase that you're only going to purchase if you get the planning? Otherwise, you don't want that property?
I'll get the planning.
Everyone always says this. I always say, what's your backup? So I'm going to get planning.
No, so the backup is, okay, so our personal size, in terms of, from a lender's perspective, like I said, realistically, if you come and value the property, we're buying it for 800, it's worth 600 without planning. So realistically, we're going to have to meet the valuation loan to value, we're going to have to put in 400,000 day one to meet the loan to value and what the valuation stacks up as.
Are you buying it more because you're hoping of that uplift rather than them selling it without planning and you just pay for what it's worth as is?
Because they wouldn't sell it. They know, basically, there's precedence that the planning we want, everybody has done. So it's worth what it's worth.
Yeah.
In a nutshell, they know there's the uplift there. They know that if they had the money, they would do it themselves, or the experience, they would do it themselves. Alfred knows we will get planning. We don't not get planning. I work with AA Drafting, best architects in London. I'm not hearing any different.
But yeah, no, the reason I asked that is because I've done deals where we put it straight on a refurb bridge. And what we do is if you said to me, if I don't get the planning, all I'm going to do is refurb it anyways, we'll just put it straight onto a refurb, and we'll say, if you don't get the planning within 4 months, we'll just switch that facility to the smaller facility for just a normal refurb versus the larger one if you did get the planning. So you still have that flexibility is what I'm trying to say in terms of...
I think our downside is because they know of the planning game, we're paying a premium. So if we buy that property tomorrow, we buy it for 600. So we buy it for 800. We spend 100, and it's worth 800. So we're at negative. By the time we take into fees and stamp duty, etc., we're at negative 160,000. However, because there's like a 95% chance that we get the planning and we get the uplift, it's worth the what if.
Yeah, but I suppose, as I said, with lenders, we'll work off the GDV. So if you say it's going to be worth 1.1 at the end, we work 1 figure regardless. At day one, you're not going to get that close to 800. We'll only be able to give you 75 or 600. We won't penalise you because we know it's going to be 1.1 at the end, basically.
Yeah, no, that makes sense. See, look, I get to ask my own questions. It's the benefit of doing these lives, just free consultation.
Exactly.
Okay, so another question that was asked, if we go back to the buy-to-let space, was asked the difference in rates from a where was the question? Difference in rates on a personal name versus a company name from buy-to-lets. I believe it was like specified HMOs, but I don't know if that makes a difference.
Sure. So depending again on the lender. So lenders have different products for HMOs, different products for normal buy-to-lets, and then there'll be some lenders that will price differently for limited companies and personal names. So myself, it doesn't matter if it's limited company or personal names, it's the same pricing, but you will find your more high street or your second kind of tier lenders will be price driven depending on the entity. Also, there'll be a stress test depending on it as well. So if you're in a limited company, the lender might want the rent to cover 125 times or 100 times cover, whilst if it's in a personal name, they might need 140 times cover, for example, depending on your...
Okay, and is that obviously nothing's 100% standard, but generally speaking, is it stressed more diligently in a personal name than a company name?
Depending on your tax bracket, yeah, they may do a higher stress if you're a 40% taxpayer, for example.
Okay.
So yeah, so it's very lender to lender again.
Okay, yeah, that makes sense because obviously it's about the actual returns you're going to get from that property. Because if both of our rents are exactly both of us get £2,000 a month in rent, but one person is paying 25% tax. Do you know, I didn't actually ever know the answer to that till you said that. So I'm just learning.
What
Today's a
money
good day.
he's got smaller corporation tax versus
Yeah. Okay. Now that makes sense. I didn't actually ever think of that. I always just wondered why. I thought, I don't know, maybe because the companies have more assets, but I always thought that could be different from that changes based on the applicant. But yeah, that makes a lot of sense. How do you get the value of the property? How do you get the value of the property with and without planning? Well, with planning, it's based on whatever the value of your plans are. So if you plan to build two houses in the garden, they take the value of what those two houses would be worth in the area plus the existing house, and that's what the value is. And without planning, they just value like a normal bricks and mortar valuation of whatever's currently there. Alfred, what is Alfred asking us?
market research.
Okay, I think maybe he's answering indirectly the question above as well. But yeah, that's a lot of the time the values, yeah, just come down to what the surveyor says as well. So when the lenders send out their surveyor, they'll value, that's your end of discussion really. Once they've said what the value is, that's the honest answer of where your values come from, because you can be buying it for whatever you like. But if the surveyor doesn't agree, then
basically.
I'm so bad at reading, like trying to multitask and double and that, and also carry on talking. When will specialist lenders become more flexible? As it stands, when you take out a mortgage in a limited company for a fix for 5 years, you're not able to switch more mortgage products. Do you want to answer that?
Sure. So again, depends on the lender. So we have a product which is a 5-year product, but after 3 years, there's no penalty, so you can move without having to pay any early redemption. So again, find the right lender, find the right product. Maybe take a 2-year fix or a 3-year fix if you don't want to be tied in for so long. Especially nobody knew COVID was going to happen and all these interest rates were going to drop basically. So a lot of people benefited if they were on a tracker or a variable. A lot of people that were fixed in, they were probably a little bit annoyed, but yeah, there is lenders that allow without, you know, some ERCs as they call it. Also, depending on the lender, you can be quite flexible, so you can
Can you tell us? I hate you acronym people. What are ERCs? Can we have that? Oh, okay, fair
yeah,
enough. Just checking.
no, of course, but yeah, it's just quite the right lender that will help you get the more flexible products.
Okay. No, I think that's good. And also, like, just from my side, you're just as responsible for picking your product that's fit for purpose. So if you know you're going to sell the property in 2 years, why did you sign up for something that has a 5-year early redemption penalty? Like, you know, there's loads of products out there that you may be charged more on a monthly basis, but then you save the money when you come to sell the property. And I think that's why you've got to really just make sure you live in those spreadsheets and live in the numbers. Like, if work out what your cost of finance is going to be, which includes your monthlies, your arrangement fees, your early redemption penalties, and also with, like, you know, marry that with what you plan to do with the property itself. I think maybe one of the cases where some people get stuck is, like, within the last 5 years, lenders have become a lot more stringent with what their, like, rental requirements are for the property to stack. So I think sometimes as an investor, even if I know, like, you know, the rents are higher or I'm going to HMO it in the future, the property only stacks if I take a 5-year product.
Yeah.
And I've got some friends that do deals where effectively they buy products, rent them out for a period of time, and then afterwards they work in Article 4 directive areas where they convert them to HMOs. and want to switch the product or package those to investors at fixed yield purchases, because they can get a higher commercial valuation than they would on bricks and mortar. But they're kind of stuck between, they can only buy the properties in the first place, they take them on a 5 years, but their whole business model is based on them switching in maybe 2 to 3 years. But then you mentioned obviously you have products that would almost be fit for purpose for that.
That, and also a lot of people, when you say they'll find out what the early redemption cost is, and if there's some that'll be 3%, some that'll be 1%, and some will take that 1% hit, knowing that if I have to sell within that term, does that 1% make sense? Would I still make a profit? So again, just put your numbers in, see if you have to break the loan, does it money on the back end?
Yeah, no, exactly that. Harris 8 has said he's messaged you, Sherena, and he looks forward to your reply.
Will do. Look at my DMs at one point.
No problem. Oh, Luke. We also got Luke. Got a lot of people that are actually going to be on this segment. So we got Luke's Properties, been investing over in, I want to say South Wales, but I think he's going to correct me when he comes on. But that's, again, somebody who's gone outside of London and has worked on making deals work on smaller, lower purchases. So I think I saw Tej recently did the post about like myths in terms of being able to get finance. And I think some myths he wanted to debunk were that you can't get a mortgage if you've got, bad credit, or like some bad credit. You can't get mortgages if the property is worth less than 75,000. And that's one I've heard quite a lot of conversations around. Are there still lenders that will lend at less than 75,000?
Yeah, there's lenders that are doing 25, 50,000. There is.
Wow.
You will pay probably a bit higher pricing, because how lenders look at it is, a loan for 25 or 50,000 is the same amount of work for a loan for 300,000, and the profit they make from the smaller loans is not as good as the bigger loans. So to kind of be clogged with so many smaller loans, they make a minimum loan amount. So for example, we had a minimum loan amount of 100. It's now creeped up to 200, just because the 100k below didn't make us any money. So we wanted to make sure that we get more profitable loans. So it's really hard, especially with first-time buyers, first-time investors that are looking up north, and they're buying properties for 100, 150 to 200,000. I can't potentially help most of them because their loan sizes are too small. But there is lenders that will do minimum. I think the norm is 50,000, 25. I think there's only one lender I know, but between 50 and 100 is kind of standard in terms of the loan sizes.
Yeah. Okay. No, that's good. That's good to know, because I know a lot of people, particularly when they're looking to invest, London property prices have got so high that they've, have enough potentially for what would be a residential deposit of 5%, but can't meet the 25 to 30% deposits for buy-to-lets or for investment properties, but they don't have a requirement for, for a residential property at the moment. So I think it is good that obviously people can still look at other areas, can network with people like Luke, like Tej, that are already doing it outside of London. So it's good to hear from you as well. Now, let me go through the questions, because there were a few more in the question box. Somebody asked a question that was like, which I think you've answered already, actually. For first-time buying at auction with good credit, what would the average interest rate on a bridging loan of 250,000 on a fixed term for 12 months be?
So again, it can range depending on the asset, where it is, what loan to value. But let's say you want a 75%, you're probably looking between 0.7, 0.79, anything there per month if you've got good credit.
And I guess that moves, from my experience, quite a lot based on your loan to value as well.
Yeah, so there's different thresholds. So if it's sub 65, sub 50, or 70 will determine the pricing, basically. And
so for those, again, that might not be as experienced, 0.7, can you kind of explain 0.7? Do you have a calculator up?
I have. If you can do 0.7 times 12, which is actually, no, I should know that, 8.4, right? Okay. 8.4 per month. Yeah. Per year, sorry. So the rate for the whole loan for that 12 months will be 8.4%. And it's monthly. That's why it's 0.7 per month.
That is, because you know what, I think a lot of the time, in terms of getting into development, it's just almost understanding finance. So understanding what, because when I was first getting these letters, like say, oh, we got a great deal, that we're doing this at 5.5, but then what's going to happen if you don't meet your terms? You're going to jump to X. And I think if you are getting into developments, really understanding that when you get a term sheet sent over from a lender or from your broker, understanding what those actually mean and how to put them into a spreadsheet or however you calculate your numbers to make sure that the deal still stacks for you, because finance costs are expensive. Like, let's not hide that fact.
No, say just be, you know, with every bridging or buy to let product, there'll be an arrangement fee, there might be an admin, there'll be valuation costs, there'll be legal costs, and then also just check, because bridging, usually there won't be an exit fee, but some bridges might put an exit fee into there or a minimum term. So double check that. And the other thing that is important is that overturn bit that you talked about. So a lot of lenders, if you don't finish and come off that term within the set period of time, you may get into hefty fees, which could be anything like 2% per month, and that could then really eat up into your profit.
Yeah, I think that's key. I'm sorry, V2 said, I'm thinking of buying in auction, but I have a good amount of equity in my residential. Do you recommend using that, or just taking out the bridging loan for a deposit, buying, flipping the property? I'm not sure exactly. I think maybe the question is, I'm going to interpret this as I like, because I clearly can't read. So I guess about the benefit of taking money out of a property and then just getting a direct bridge to buy somewhere versus potentially like a second charge bridge against an existing asset with considerable equity in it.
So I would say it depends on if you're asking for the deposit. So if you have to use a second charge bridge or raise equity out of your residential to get the deposit, then obviously that's a given, do that, because if you don't have any other cash, that's the only way you're going to put down a deposit. And then you can get the remainder on that bridge. But if you're saying, should I use equity from my property versus getting a bridge, then I would say the residential equity out will probably be cheaper than the bridge, because your rates will be like a residential mortgage rate. But then just make sure that you can afford your monthly mortgage payments, because they will also go up as well. So depends on how you're trying to structure that deal, I suppose.
Okay, because like, let's say for example, I've got an asset now, because I didn't have planning on it. It's like split commercial, currently have like no lending on it. I've got planning, so going to do it up. Like, let's say I hadn't sold that asset, so it's maybe worth 500,000, no outstanding finance. If I saw something at auction, is there any way I could use that as security without actually, like, just as basically almost like my deposit or my security? If I didn't want,
you can use that property to get a deposit out. So say you said I need 20 grand or 30 grand, get a bridge for 30 grand, or you can get a buy to let mortgage for 30 grand, or that whole property to actually purchase your other property. You can just take out all that money from that property, and then do a cash purchase for the auction. Or you can leverage off both of them if you wanted to just get the most amount out, basically, and get 75 across that one and 75 across the new one.
Nice. A lot of good questions coming up. So yeah, I forgot to actually do my clubhouse thing and reset the room, even though it's very late. So today we're talking about all things property and all things finance in the property space. So I have Sherena on, who's got 10 years of experience. Is it 10 years? It's a lot of experience. 10 years of experience. Working with all different types of finance. So she's been helping answer a lot of the questions that people have in terms of bridging loans, development finance, buy-to-let, residential mortgages, and everything in between. I'd like to take this chance to actually ask you a question. So what are your plans? So you said that you invest in property yourself. What are your plans sort of 2021, 2022? What are you going to be doing in the property space?
Yeah, sure. So I took a bit of a break, to be fair, on the property investing. So I built up my buy-to-let portfolio, and then I was kind of content and happy, because when I went into it, my strategy was appreciation and kind of long-term hold for wealth, rather than cash flow. I was trying to replace the rent for my salary. So I stopped investing in the last couple of years, but I have thought about coming back into it, but not for hold, but to do flips. So kind of buy some properties at below market value, or buy good, add some value, and then get some profit out. So that's what I'm working on this year. And hoping to do a few of those, and it does help to be in the sector of being able to get the finance, so at least I can make sure that I can get the finance on the back end. So yeah, that's my plans.
No, I think that's good. That's good. A lot of people doing some amazing things in this property space. And I think that's probably a good place to wrap up today. Obviously, a lot of people have got a lot of free information, but if you do, have any finance needs, then you can obviously add her up. And I'll give this as an opportunity for you to plug yourself, because she is the queen of Clubhouse at the moment, running a lot of rooms. A lot of property spaces where she's obliged to have me on. So go ahead, tell the people, where can they find you over the next couple of weeks?
Sure. I just want to answer that person's question that asked me if I manage my properties myself quickly. So I don't have a management agency. I'm very hands-on. So I manage all my portfolio, and that's why I choose London and South East, because I live in London, so it just makes it easier. So I buy in the same kind of areas. So that's that. And for myself, in terms of Clubhouse, yes, I run rooms on Tuesdays at 7:00 on anything property, and I also do kind of a networking session as well. Kazy is actually a co-host on my Tuesday rooms when he isn't playing football.
We're undefeated, so football and Clubhouse right now.
I know, it's okay. And then I also do networking rooms on Wednesdays and Saturdays. So please do follow me on Clubhouse and Instagram to get notifications. My name's Sherena84 on Clubhouse, and yeah, that's me.
Amazing. Thank you very much for having you on. I use your famous Clubhouse words. You've added loads of value today, which is great. Those rooms are really good. I've been part of a few of them. I've seen a lot of people in here that have also been involved. Alfred, Luke, along with a few others. Thank you for all you guys that are I see some of you that I know are here every week, and I appreciate it, taking the time out on your Sunday to come. We've got loads of good people coming up over the next few months, which includes Alfred, Anthony Laville, Karina Laporte, winner of The Apprentice, the property lawyer. So loads of good people that you can ask questions to in regards to their property space. Bilal, I see you're here every week, and I appreciate you, my brother. So I will get these up on the YouTube, on the Instagram, and yeah, hopefully there'll be a lot of information that you've enjoyed, that you've got out of this. We'll be back next week, same time, same place, and I'm gonna maybe come to club. I'm gonna be at Clubhouse at least 2 days this week. Maybe not Tuesday because of football, but apart from that, I'll be there.
Okay? Thank you.
All right, thank you everyone. Enjoy the rest of your weekend. Take care, guys.
Thanks. Bye.